You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 14th of February 2026, and I'm joined today by my co-host John McEwen. And in this week's episode, we'll be discussing Dunelm, Shell, AG Barr, Novo Nordisk, GlaxoSmithKline, and Eli Lilly. Before I start us off with Dunelm, probably worth mentioning, we did mention it at the end last week as well, but on the 24th, Tuesday the 24th of February, for anyone who's interested, we're going to go to the Fundsmith AGM. We have done it for a couple of years now. We've done a bit of a meet-up before for a few drinks, and it has been a really good event. Obviously, the AGM's very good. You get to go and see Terry speak, and he is fantastic. If anyone's not sure, you can go and watch previous year's versions online. So if you would spend an hour watching last year's one, I think you'd learn a lot from it anyway if you're still making up your mind. But yeah, for anyone who's interested, we've tweeted the link to sign up for the AGM. And if you just want to get in touch with us on Twitter, send details of where we're meeting up. On to Dunelm. Dunelm, the homeware company, they have come out with half-year results for the 26 weeks ended 27 December 2025. However, these results are following a profit warning that they issued in January, which we didn't cover. So it's probably just worth mentioning the profit warning. So they did say in mid-January that Q2 sales were only 1.6% up, which is lower than anticipated due to tough Black Friday and December trading. The total for the half was up 3.6%, but that was mainly due to the Q1 performance. And there was a downward revision of the full year profit before tax to the lower end of the guidance. And basically the shares dropped about 20% when that happened. So since then, they have come out with the half year results themselves to 27 December 2025, and total sales are up 3.6%, as they said. The digital proportion of total sales are up 2 percentage points from 39 to 41%. Gross margins improved from 52.8 to 53.4%. The net operating cost to sales ratio is up from 38.4 to 40.5%. Profit before tax is down 7.5% to 114 million. The diluted earnings per share is down 7.3%. Free cash flow is up very slightly from 168 to 171 million. Net cash is down significantly from 57 to 13 million. And the ordinary dividend is up 3%, but the special dividend is quite a bit lower. So that's 25p instead of 35p last year. I've highlighted solid first half trading despite a challenging environment. Sales growth was ahead of the combined homeware and furniture market, with market share up 20 basis points to 7.9%. We have covered them in the past, and I think they are targeting 10% market share, which isn't that unreasonable considering where they're already at. It looks like they've got a decent chance of hitting that, considering they keep gaining market share. They've said the slight increase in the gross profit margin was largely driven by FX gains, with retail prices held broadly stable. And the profit before tax decrease was mainly due to the softer trading in Q2 and the timing of certain costs. And they've said that whilst Q2 was softer, they have seen stronger sales growth in Q3 to date, which is more in line with half one as a whole. So it looks like it has picked up a bit. And they remain confident for the plans in the second half, with the full launch of their app planned for spring and furniture availability recovery plans in place. And the CEO, Chloe Moriarty, has said, "Since joining Dunelm in October, I've been struck by the magic that has turned this very special business from a market stall into a market leader. We delivered a solid first half performance despite a softer second quarter. And we are seeing stronger sales growth in early Q3 following a good winter sale and an encouraging response to our new spring ranges. With only 7.9% market share and clear opportunities to enhance and expand our assets, we see significant headroom for growth." In terms of the valuation, Dunelm now trades at a PE of 12.37 and has a yield of 4.6%. I think firstly, we've always liked Dunelm. It's always been a good operator. The main issue I've had with it has been the price. I mean, it's never been outrageously priced, but at times it's been at sort of 15, 16 times earnings. And if you look at some of the other businesses that are similar that you could have got for a lower price, I think that was always the issue. It's the opportunity cost. So, for example, it's not uncommon for Dunelm historically to have traded at a higher PE than Next, when Next was putting up better figures. I think at 12.37 and a yield of 4.6%, I think it's probably actually a lot more attractive. I know it's had that drop off in the second quarter, but it's picking up in the third already based on what they've said. I think based on how they've done historically, they're going to have a bit of a wobble every now and then, but they are a good operator. And as well, the main thing is they are gaining market share. So in terms of their business compared to competitors in the space, they are doing better. So I think if someone was to make an argument as to why they own shares in this, I think they could make a pretty strong one. I think it's a good business. What about you, John?
Yeah, I would agree. I think it's a pretty good business. I think that they do have the cyclical element to it, and with there being probably a more cautious consumer outlook, that inevitably does hit them. But I think they're probably the best operator, and they do have that high digital sales proportion, which is encouraging, and growing market share, as you say. I think the current valuation is much fairer, and it's got, at the moment at least, it's got a decent dividend. Obviously, it depends whether you can sustain that, etc. But I'd probably look for maybe higher quality businesses rather than Dunelm. That would be my feeling overall.
Should we move on to Shell in that case? A business
Yes.
you used to own.
I did used to own it through good times and through bad times. So it's one that I sold a few years ago, and it was largely, I think, because of the political outlook and how the oil companies were being treated, particularly in the UK. Anyway, Shell is the largest oil super major in the UK. It's significantly bigger than BP, and they had their fourth quarter results out. So Shell's fourth quarter revenue fell from 66.3 billion to 64.1 billion, with declines in upstream, chemicals and products, and marketing more than offsetting growth elsewhere. Underlying net profit fell from $3.7 billion to $3.3 billion, and that was below consensus forecasts of $3.5 billion, with most of the miss due to weaker gas prices as well as softer marketing margins. Free cash flow was down by around half to $4.3 billion, and it was impacted by lower profitability and payment for emission certificates. Net debt was up $6.9 billion to $45.7 billion. And Shell declared a $3.5 billion quarterly buyback and raised fourth quarter dividend by 4% to 37 cents a share. Capital expenditure in 2026 is expected to be around $20 to $22 billion, which is in line with last year. And the shares were down nearly 2% in early trading. In terms of valuation, Shell has a market cap of £162 billion and trades at 12 times forward earnings, compared with the 10-year average of 10.7, and it has a prospective dividend yield of just under 4%. I thought these results were fair and broadly in line with expectations. I think what we've come to appreciate with Shell is that it's an excellent operator, certainly better than BP, and it does trade at a significant discount to its US peers. So I think with fossil fuels overall very much back on the agenda and the race to net zero slowing, it almost really appears no longer to be an industry in structural decline. I think particularly when you consider the new industry of AI needing huge amounts of power, and that largely essentially coming from fossil fuels, it does make it, again, a more of a long-term prospect, I would say. And certainly if you were looking for an oil super major, Shell would certainly seem attractive in terms of operationally being great, but also on a valuation, particularly being listed on this side of the pond compared with those more expensive US peers. So I think on that basis, you can make a strong investing argument for Shell. I held it for a number of years and did very well on it. Not sure whether I regret selling it or not, but I think the political side certainly in the last few years has been a bit more concerning, that it's been sort of targeted and kind of almost blacklisted in that sense. So that's where I am with it. Sam, what are your thoughts?
Yeah, I think it's a good business. I don't think these results are amazing, but as we've discussed before, they don't set the price, they take it. So there is going to be an element of cyclicality. I think it's a very high quality business. I think the LNG side of the business,
I think and this is estimated, it's probably between, so revenue, it may be as much as 20%. And in terms of the earnings,
I think it's a lot more profitable.
it's like it could be up to 40%.
Whereas if you compare that to BP, I think that's more like 20%.
Yeah.
A lot lower for BP. But I think that LNG side in particular, although it's fossil fuels, it is much more energy efficient than some of the alternatives. It's reliable, it's cheap. Yeah, I think it's a good business, and I think it's well placed, and I think I do prefer it to BP. I don't know if I'd want to pay 12 times earnings for it, given how cyclical it is, especially with that yield being under 4% now. I think it's a good business. I think it's an industry that's going to be around for longer than maybe we would have thought a few years ago. But given its cyclicality, if you were interested, you'd probably, if you were patient, get it at a better price than the current one.
Fair enough. On to a less cyclical business.
Yes, AG Barr, a business that has grown on us with time. So for anyone who's not familiar with AG Barr, they are the drinks maker, and amongst their brands, they have Iron Brew, Rubicon, Boost, Funkin' Cocktails, not quite at Britvic levels, which we used to cover before it got bought out by. You bought that out, was that?
Heineken, I think.
Okay, so not quite as big as Britvic, but some good brands and a good little operator. So AG Barr have come out with a full year trading update, and the company delivered a strong performance for the year in line with expectations. Revenue growth was about 4% to 437 million. Adjusted operating profit margin was approximately 14.7%, and that's up from 13.6% a year ago. We said that increase was contributed to double-digit profit growth. This is driven by benefits from ongoing efficiency initiatives and supply chain investment. The adjusted return on capital employed was maintained at target level of approximately 20%. Said marketing and distribution initiatives supporting Iron Brew delivered modest growth in the second half following a flat first half, with good performance from Rubicon and Boost offsetting a decline in Funkin'. Highlighted continued investment in manufacturing sites and improving both capacity and capability, delivered as planned and on budget. And they've announced the acquisition of Frobishers for 13 million, which was completed towards the period end, and that's been funded from the net cash position. So Frobishers, I'd never heard of it, but when you go on the website, it looks like quite a nice brand. So it's all like juices and stuff, and it's made by a guy who used to be a pub landlord. It looks like quite a nice brand, actually. But yeah, so they do loads of juice drinks. So they'll do like lemonade, elderflower stuff. You can actually go online and they do loads of different juices and stuff, and you can do like a box of 24, and you can pick loads of different ones. So they've got orange, apple, bumbleberry, whatever that is, cherry, mango, cranberry, tomato. So they've got loads of different stuff. So hopefully that will do well. Having never heard of it, I have to say, on the surface from the website, it does look like a decent brand, but that's just based on my initial impression and nothing else. So, yeah, they bought Frobishers for 12 million, and that was at the end of the period. And post-period end, they've also acquired Fentimans for 38 million, and that will be funded from a combination of cash and debt. Have you heard of Fentimans?
Yeah, absolutely. You see it in a lot of sort of trendy coffee shops as a cold drink. You know, they might have ginger beer or cola and things. Yeah, I think that's a decent brand.
Yeah, okay. I'd never heard of it, but obviously you go to more trendy coffee shops. But yeah, so, I mean, again, that looked like quite an upmarket brand. Whether they'd be thinking they'd be able to... It looks like the kind of brand where they might be thinking they potentially give Fever Tree a run for their money.
Yeah.
But yeah, again, on the surface, looks like a decent brand. The fact that you've heard of it is also helpful. They've said the integration of both Fentimans and Frobishers will take place in the 26-27 year, with associated efficiencies beginning to come through in the second half. And they've had a strong brand activity pipeline continuing through the 26-27 year, including redesigns of Iron Brew and Rubicon and further innovation launches. So in terms of valuation, AG Barr trades at a PE of 16.57 and has a yield of 2.53%. I think, given the way it's performed operationally in the time we've covered it, I think a PE of 16.5, whilst it's not cheap, and it's not as cheap as it used to be, I think it's pretty fair for the performance. I think it's still got a number of brands that operationally, I think they've always been a good performer. I think they've got some good brands that can potentially do a lot with. I think those two acquisitions seem quite promising. I know Funkin was down in the period, but I think that's been a very good acquisition for them, and that's worked out very well as well. So I think they are putting together a nice portfolio of brands, and they're still quite small. So in terms of the market cap, it's only 740 million. Whereas when we used to cover Britvic, I think that was about 5 billion or something. So there is a lot of room for growth if these brands are managed correctly. So yeah, I like it. I don't know if I'd go out and buy it. I think it's just the opportunity cost, but I think it is a good business, and I think you could make a strong case for it. What about you, John?
Yeah, no, I would agree. I think it's interesting, the acquisitions that they've made. They seem to have been quite smart acquisitions, and it's almost like a bit of a quality pivot. Obviously, you've got Iron Brew there as a core brand, but you do wonder, apart from in Scotland and I guess the rest of the UK, how big can that get? But with these other ones, I think there's a runway for much more growth, and particularly in a market where there are GLP-1s, and I'm sure we're going to come on to those later in the show, and potentially volumes of things like Iron Brew dropping. Having those more upmarket things with bigger margins is certainly, would seem in this market, a sensible way to go. And yeah, as you mentioned, Funkin, I know it hasn't performed so well just most recently, but that has been great. I think Rubicon again is good quality, and MoMA as well. That sort of more healthy, well, I don't know whether you debate the health thing, but the vegan argument there as well. So I think it's being run very well. I know there was a change in CEO after a long time, but the sort of sensible strategy seems to be continuing. I think these results are fine, but you would be hoping going forward we'd be able to accelerate things a bit more.
So speaking of GLP-1, should we move on to Novo Nordisk?
Yes, absolutely. So it's one that we both own. At one point, it was Europe's largest company. It has fallen quite a lot since then. They had their Q4 results out last week, and 2025 sales before currency moves increased by 10% to 309 billion Danish kroner, led by a 41% uplift in sales of the anti-obesity jab Wegovy. Operating profit grew by 6% to 127 billion Danish kroner, which was in line with guidance, and held back by restructuring costs and the integration of manufacturing sites acquired in 2024. The timing of that transaction contributed to a positive movement in free cash flow, which moved from an outflow of 14.7 billion Danish kroner to an inflow of 28.3 billion. Net debt was 37% higher at 95.4 billion. And Novo intends to declare a final dividend of 7.95 kroner a share, and has launched a fresh share buyback of around 15 billion kroner. In 2026, underlying sales and operating profit are both expected to fall between 5 and 13%, and shares were down nearly 17% in early trading. In terms of valuation, Novo has a market cap of around 1 trillion Danish kroner, which is around 116 billion pounds, and trades at 16.8 times forward earnings, compared with the 10-year average of 23.3, and it has a prospective dividend yield of 3%. I thought these results were broadly what was expected after the previous warnings. And yes, I suppose that is disappointing to some degree. But I think objectively, it's still good, with a 10% increase in sales and 41% sales uplift when it comes to Wegovy. And the operating profit is still up 6%, despite the expensive restructuring costs and integration of the manufacturing sites. My overall view would be that Novo still has its very steady conventional diabetes business, which is being consistent and reliable over a number of years. And whilst there are uncertainties, and I appreciate these are big uncertainties, who the winners are going to be from the GLP-1 market, Novo is still likely, in my opinion at least, to form part of that. And it was kind of the first there. It has sort of the first mover advantage. And I know we saw huge growth in the share price around sort of 2020, 2022, which was probably, overdone, but it's still got most of its patents, which in the developed markets at least are lasting till the early 2030s. So I think 2031, 2032. They've also launched oral Wegovy, which has made a very good start in the US, and they're waiting for the approval of the next generation CagriSema, which is likely later this year. And obviously we'll have to see how that does. There have been other concerns in terms of pressure on the margins when there have been some sort of generic competitors coming out, particularly in the US. But I still think, it's got some good brands. They seem to be very effective. We'll come on to Eli Lilly, and it is highly competitive. But even if you had Novo potentially with a slightly cheaper product, I think there's a lot of room for growth because it's not a mature market yet. And when you look at Novo, it's almost at the sort of valuation, well, I think it is even below the valuations that you had before these GLP-1s were even around. I think that tells you a lot, even if you were just buying it, assuming that there was no future with the GLP-1s from Novo. I think you'd still be getting a good business at a reasonable price. But if there is upside to that, and I think there very likely is, then it makes it even more attractive. So certainly I'm very happy holding my shares. I may well look to top up, but I still think this is a really high quality business, and probably top tier when it comes to diabetes. We'll come on to it. I know we're going to move on to Glaxo next. Certainly when you look at Eli Lilly, you could argue that Novo is less diversified because it is primarily a diabetes, I guess obesity now, but diabetes business, with 90% of the sales coming from that and only 10 from other pharma aspects or other areas like rare disease. I'll ask you what you think, Sam, and then we'll move on to Glaxo.
I hope you're right. I think that 41% growth in Wegovy, I think that's really, really positive. I think the drop next year in the guidance is disappointing, but like you say, that's been driven by a decision to do it deliberately to try and increase market share. So hopefully that works. I think it's probably worth not reiterating, but going over it, because Terry Smith did cover it in his letter to shareholders at the end of last year. And I'm sure he'll get a question on it at the AGM as well. Actually, I'd be stunned if it doesn't come up as one of the chosen questions. But so he said in his letter, Novo Nordisk managed to reaffirm my belief that you should never say things can't get any worse. The company parlayed a market-leading position in what is probably the most exciting drug development for about 3 decades into a secondary position and has failed to prevent illegal generic competition in its core US market. One of our mantras has been that we should always invest in businesses which could be run by an idiot so that performance is not heavily reliant upon management. We've been made painfully aware that the range of businesses which can be run by an idiot is much more limited than we thought, and hereafter we will aim to be more aware of the impact that poor management can have. Our experience also suggests that when we encounter poor management, engagement to change it is less effective than selling the shares. Meanwhile, Novo Nordisk has appointed a new CEO and made wholesale board changes, and the present rating, P of 13, appears, so this is obviously 17 was the forward PE, so he was using the current P of 13, appears to be, to us, expecting very little. If we did not already own it, I suspect we would contemplate buying it as a good business which has been depressed by a glitch, albeit a rather large glitch. So he's holding, so fingers crossed. But yeah, I think the guidance is disappointing. But like you say, it's a deliberate decision to gain market share. This is going to be a big, big market, and it's still early days. So I think even if it ended up as, which it's looking likely now, as a number 2 player, could still be absolutely massive for the business. So fingers crossed. Should we move on to Glaxo then?
Yes. How are they doing, Sam?
Better. So GlaxoSmithKline, pharmaceutical company. They have come out with their full year results, and full year sales grew by 7% before currency movements to reach 32.7 billion. Specialty medicines were the key contributor, which were up 17% as cancer treatment sales rose over 40% on strong patient demand and new use cases for certain medicines. Underlying operating profit was up 11% to 9.8 billion, slightly better than forecast and reflecting the positive impact of a shift to higher margin products and efficiency gains. Full year free cash flow grew 41% to 4 billion, helped by profit growth and lower investment in physical assets. Net debt was up slightly from 13.1 to 14.5 billion. 2026 growth guidance range is 3 to 5% for sales and 7 to 9% for underlying operating profit. The 2031 sales outlook of over 40 billion remains unchanged. They declared a quarterly dividend of 18p a share, and that takes the total for the year to 66p, and that's on a share price of £21.65. The shares rose 4% following the announcement. So this was the first set of results for the new CEO, Luke Meals. And although compared to 2025, the focus has moved slightly away from product approvals towards late-stage trials, pushing the probability down and the timeline out for potential commercial success. Headwinds for US vaccine sales have been offset by strong demand in the category overseas. And they also have a strong presence in HIV treatments, which make up about 20% of total revenues. And the cancer treatments, which are small in terms of current sales, are growing rapidly. In terms of valuation, it trades at a forward P of 10.6. That compares to a 10-year average of 10.6. The prospective yield is 3.6. That compares to a 10-year average of 5.5. I think these results are very good, actually. I think I'd have concerns about the pipeline and valuing it. But I think at a forward P of 10.6 for a business putting up these results, I think you could do a lot worse. So yeah, I think it's decent. The yield's a bit low, but I think the valuation is very reasonable. What about you, John?
Yeah, I mean, I agree with you in terms of it as a sector. And I think particularly when you get more diversified pharmaceutical businesses like Glaxo, it is obviously critical on the pipeline to really get an edge or an insight, is really understanding the drugs and the pipeline. I think on the surface, these are good results from Glaxo. It had underperformed AstraZeneca, which used to be the smaller of the two big pharma companies in the UK. And Astra has just, completely outshone Glaxo over the last 10 years. And Glaxo have spun out the consumer health division. And I know we've covered that plenty of times, but it does feel, particularly with those cancer sales and the oncology branch, along with their excellent vaccine business, that things are picking up. And it is encouraging. I think you can certainly make an argument for it at 10.6 times. Was that 10.6 times forward earnings?
Yes.
Yeah, I think you can certainly make an argument for it then. It's always difficult, though, with the pharma companies, because you can see quite large swings depending on how far through clinical trials they get and if there are any major disappointments. So I probably wouldn't feel like I had the expertise to invest in Glaxo, but it looks like the best it's been for some time. Interestingly, if you compare it with Astra at the moment, Astra trades at 18.3 times forward earnings. And I appreciate it has put considerably better numbers up for a much longer time. But I think there may well be some value there to be had in Glaxo. Out of interest, what was the latest market cap for Glaxo, did you say?
I didn't say, but I can say.
Okay.
So the market cap for Glaxo is 86. Well, it's just under 87 billion.
Yeah. So Astra is now 234 billion.
Oh, they should look at acquiring it.
Well, yeah. And in fact, let's just go back. So let's have a look at the last 10 years. So Astra.
So 10 years ago, it was about £14 a share, Glaxo, and it's now at 21, so it's only up about 50% in 10 years, excluding dividends.
And Astra, excluding dividends, is up over the last 10 years, 271%.
Well, that'll be what's caused it.
Okay. I'm pretty sure Astra have had the same CEO for like that time as well, which is obviously a top operator. You could make the argument run by an idiot, but I don't get that.
Hard for an idiot to run a pharmaceutical. I'm surprised Terry would try and apply it to a pharmaceutical company.
Yeah,
compared to like Coca-Cola or something.
That's right, because you think with sort of brands, it's much easier to make that sort of argument with a very defensive, consumer goods company. But
unless you just thought the GLP-1s was such a home run.
Yeah.
You couldn't mess it up.
Yes, yeah.
But they have.
Well, that's right. Shall we move on?
Yes. How are the company that have stolen the market share from Novo Nordisk doing?
Absolutely. So this company, Eli Lilly, it's absolutely ginormous. So if we look at all of the companies together that we've covered on this show, today, it's not even half the valuation of Eli Lilly, or we getting towards half. Even if you added Astra in there, it wouldn't be coming to the total market cap of Eli Lilly. So that's the size, the sheer scale of the American pharmaceutical company. They had their fourth quarter results out last week, with fourth quarter revenue growing by 43% to $19.3 billion against a consensus of $18 billion, driven by volume growth in its bestsellers Mounjaro and Zepbound. Underlying operating profit was up 42% to $8.6 billion as revenue growth outpaced cost expansion. 2026 sales are expected to land in the $80 to $83 billion range, reflecting growth of 25% at the midpoint and better than consensus forecasts. Underlying earnings per share guidance stands at between $33.5 and $35, implying growth of around 41%. Shares were up nearly 8% in early trading. In terms of valuation, they have a market cap of $945 billion, and they trade at around 29 times forward earnings with a 10-year average of 28, and they have a prospective dividend yield of 0.7%. I thought these were truly excellent results. They're certainly the top dog when it comes to the GLP-1 market in the US and globally, but particularly in the US. And they have their own weight loss pill coming in the second quarter, which will compete with oral Wegovy. It's also worth saying that the business does have more diversification across pharma. So it's more of a huge pharma company rather than just sort of a diabetes and obesity pharma company, with around 65% coming from diabetes and obesity, but 14% from oncology, 8% from immunology, and cardiovascular and neurology accounting for around 10 to 15%. So it is broader in that sense. But the big growth story has been in that sort of GLP-1 and the obesity/diabetes space. And they do objectively, and certainly in the trials, seem to have the best product. With Mounjaro, seems to be the most effective. And they are obviously working on their next generation too. So I guess you've got that argument about the pipeline. And operationally, certainly compared with Novo, which have made a bit of a hash of it, seem to have done the best job there. And you're seeing these really, really impressive numbers coming through from them. The other thing is that they are US based and a lot of the manufacturing takes place in the US. So there are the sort of tariff headwinds that some of the other pharmaceutical companies face, which is obviously very positive for them. They come with a premium valuation. It's debatable whether how much better a business you think it is and whether it deserves that. It's certainly much more expensive. I like the business a lot. I would really like to own it. I'd probably be nervous paying 28 times forward earnings, but it's incredibly high quality, probably the highest quality pharmaceutical business around. So you can see why it comes with that. I think as a sort of at your average retail investor, whether taking sort of a basket approach is safer and accepting the high price of Eli Lilly, but putting in things like Astra, Glaxo, Novo, into that mix, that might be an argument to make. But what a business! What do you think, Sam?
Yeah, superb set of results. You see why it's such a problem. I suppose, I guess the only sort of counter I'd be able to make, these results are superb, and the way they're executing on the GLP-1s, considering what a large business they already are, is just absolutely superb. But I suppose with Novo being smaller, the GLP-1s will have a more meaningful impact for them. So as a sort of pure GLP-1, that being said, Novo's obviously still got this massive insulin business. But I just question at that size when they've got all the, because the other categories, they're not going to be growing 43% a year. So can they sustain that? And it might be that they can. And if they do, it's a real big problem for Novo Nordisk. But yeah, I think if you take a lot of the arguments that we've been making for Novo Nordisk and apply them to Eli Lilly, I think it also looks very attractive. I think at 30 times earnings with those growth rates, and we're still very early in the GLP-1s. And like you say, they've got the benefit of the tariffs. I think at just under 30 times earnings, it's not cheap, but you can see why people might be willing to pay up for it.
I think, coming back to Novo when it's, on the, I guess, the Wegovy front, in the UK, at least, I think there was a 1-year deal for Mounjaro, in terms of the price. And since the price in the last, I don't know when it came off, it was maybe September, so sort of last 5-6 months, the price of, for consumers to buy Mounjaro has gone up significantly. So you are seeing people actually switch to Wegovy just because it's cheaper. The other thing with Wegovy is, in the UK at least, it's been licensed to have essentially a triple dose compared with what it was licensed for before, which, my understanding, you're getting more towards the level of effectiveness in terms of weight loss that you were getting with Mounjaro. Of course, that doesn't mean that you're needing to pay up for more Wegovy, but whether there's an element of being able to undercut, and if you're looking at a global strategy and a global GLP-1 market, whether that's, positive for Novo, potentially. Obviously, Novo does have new products coming down too. But to counter my own point and that argument is that, yes, in the Western markets, the patents are quite long for Wegovy. In some of the developing markets, they're much, much shorter. So in those other markets, there's probably going to be generics coming through very soon, which is essentially the same product, but without Novo making the large margins on it. I think there are certainly sort of pros and cons, and there's no doubt that Eli Lilly is the top tier and owns the majority of this market, I think.
So in terms of the 6 businesses we've covered this week, then Dunelm, Shell, AG Barr, Novo Nordisk, GSK and Eli Lilly. Which do you like the most? Which do you like the least?
Oh, it's a good question, Sam. It's a tricky one, I think. I'm going to stick with Novo. It's the only one of the companies that I own. I like the business overall. And as you say, the traditional diabetes and insulin business is still very strong. And I think it's at an attractive valuation. So if we have the benefit and the bonus almost of the GLP-1s being a success in the future for Novo, well, that's great. But even if we don't, I think you still got a good business there. And I would expect it to perform over the longer term. And bearing in mind, it's an old business. It's been around for, I think, at least 100 years. So I'm positive on it in that sense. If valuation didn't come into it, obviously Eli Lilly would be my pick. In terms of the company I like least, that's difficult because I think all of these companies are actually good companies this week. So picking a least favorite is tricky. I'd probably go for Dunelm. I think there's a cyclicality to it, and it's a difficult market. So that would probably be almost just by default, but that's being a bit harsh on Dunelm.
I think, although I do own Novo and it's quite a significant position, I think I'm at a point where I wouldn't be buying any more of it. But that's partly because the position's large enough. So I think today, if I was going to go out with my own money and I had to buy one of these, I think I'd probably go for AG Barr. Don't think I'd quite feel confident enough paying up for Eli Lilly. Especially with the experience I've had with Novo Nordisk. I think least favourite would probably be Glaxo. I don't understand it, and although I don't understand Novo Nordisk either, I think with Novo Nordisk, sort of that clear opportunity in the GLP-1s, I feel like it compensates for the fact that the rest of the pipeline, I don't really understand it that well, because I argue we don't need to, because that's not where the growth will come from, assuming there is any growth. But yeah.
Yeah. Okay. Well, thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.